Well, good afternoon, investors, and welcome to the April Fools. I almost hesitate to say it. April Fools edition, April 1st, 2025 of Bull Sessions. My name is Mark Robertson. I am joined here by, that chiseled hunk on the right there, Ken Kabula. Sun's out, guns out.
That picture in the upper right is me, right?
Well, good afternoon, sir. How are you? Is it as chilly up there as it is here?
It is a gorgeous looking day, Mark, but it is cold. It's about 40, 41 degrees, and it's very cold. We had straight line 75-mile-an-hour winds come through here on Sunday night, and it blew trees down everywhere. We did not have tornadoes, but we had straight line winds that were equal to a Category 0 or a Category 1 tornado, and they came right through our townships. So we have quite a bit of damage, not where we are, although in the forest behind my house I have 3 big trees that fell during the winds, but they luckily fell down the hill, not up the hill. And but they're down at all around the neighborhood. We have big trees, especially some of the big pines and spruces. They don't have root systems that are as secure as some of the hardwoods, and they really took it on the chin. So we had chainsaws going everywhere.
My tree-hating wife was actually cheering on the storm with a couple of our evergreens, thinking she might save us some money in cutting them down. But those will be the last ones to fall anywhere in the state. So
or they'll fall on your roof, one of the two.
That too, but we have a good insurance guy. All right, so Michigan has quite a few areas that are still without power. So Kim and Matt are also here with us, and you guys are fortunate to be out of the storm zone. Good afternoon, Kim. Florida's
Good afternoon, Tom. We had a whole bunch of wind on the weekend. Like, you're seeing palm trees at a 45-degree angle.
Yeah, and that storm went through Georgia too, I believe. So.
Yeah, well, it damaged some of my hurricane chuck.
Good stuff. And Houston is probably the eye of the storm, the calmness. Good afternoon, Matt.
78 and hazy. I guess I'll take it, relatively speaking.
Oh, you got to.
Mark, Phil has his hand in the air. And Phil, if you want to unmute yourself, we'd be glad to hear what you have to say. But you're self-muted. You'll have to unmute yourself, Phil.
That may be from his question just a few minutes ago.
It was from before. I tried to take it down. I'll try to take it down.
Okay.
Thank you.
Okay, thank you.
All right, so I have to confess, I've watched, maybe a couple minutes of White Lotus. I don't think I understand the frenzy. It's one of the top-rated programs. That's the scene from the upper right up there, and it was the inspiration to bring back our spring break photo from last year. I'm not sure I get it. I get it about as much as I understand the stuff being published or discussed about the tariffs. So we might take a bite of that here within the next week or two, especially as some of the reality starts to land. There's a whole lot of speculation, a whole lot of confusion, and as I told a number of people who asked me about it this weekend, probably 99% of what you're hearing isn't actually happening. And it'll just let it run its course. It'll be interesting to see where they end up.
What I find so interesting, Mark, is that there's thousands of people talking about it, and 2 of those people are going to be correct, and then they're going to be famous for being correct,
Well, there you go. That's like tossing out investment ideas, one in one direction in the morning and the other direction in the afternoon, and then only talking about the one that turned out to be right. I mean, it's actually a strategy. And we're going to do a little bit of an exercise on Buttonwood briefing by artificial intelligence. So we'll have a little bit of fun with that. But yes, today is the Motley Fool's national holiday. I have been a correspondent with the Motley Fool for the better part of 30 years now. I mean, they used to write a column for Better Investing. A fairly few number of people know that they the launch of the Hidden Gems newsletter was at a Better Investing event, the national convention in the Washington, D.C. area, where people filed into the room, and the very first issue of Hidden Gems from Tom was part of the program that day. So that relationship goes back a ways. And again, happy Fool's Day to everybody out there. That's a capital F, and that's good investing. All right, let's go ahead and roll on.
I'm just going to ask, does anybody in the audience have a birthday today?
Well, we had one yesterday that I know about.
Well, I have a family member whose birthday is today, and no one ever believes them.
Oh, today. Because it's April 1st, huh?
Well, yeah, it's April 1st, and her siblings didn't believe her when someone called to say, hey, your sister had a baby. No, she didn't.
That's one of the things you're not allowed to joke about.
Yeah.
All right, this is our
All right.
weekly reminder that Portillo's is not a sponsor of the session, although they should be. That is an actual live, well, not live, but an actual photograph from one of the members of the Four Corners Investment Club. Just sent it our way. So, Ken, that's meant to tantalize us.
Is that a carrot on top of the hot dog, Mark?
No, that would be tomato
I guess an
slices.
outside of a tomato.
Yeah,
Is that a
tomatoes.
tomato slice? Okay,
Yeah.
I was thinking it was a carrot, and I was wondering where the heck did a carrot come from on top of the hot dog? But
Fancy
I can understand
peppers,
the tomato slice. Okay.
relish, and that substandard hot dog, as you believe.
Also a big pickle there, isn't there? Yeah. Okay.
And there's a look at the Ishimoku chart for cloud, I should say, for Portillo's. Again, we don't know how to read it, but it's a bunch of ketchup and relish, so we just keep throwing it up there. And we're going to eventually, just like following the chickens into the barnyard to try to read from the chicken scratchings in the dust. No, it's more than that. I actually have more faith in it, and the point and figure at the bottom also applies. So we'll just leave it at that for now. We are going to cover this subject. I'm telling you. Can't just control yourself. You going to be okay?
I'm gonna keep going.
All right. No investment recommendation is intended by anything that we do here. This is entirely about demonstration of the philosophies, methods, and techniques of the modern investment club movement. So we're basically taking 8 decades of experience and lessons learned. None of us have been around for the full 8 decades, but some of us have a few decades doing this. And it's just a fascinating thing to watch how you can discover and analyze and deploy an idea. And that's really what this is all about. So please do your own homework before you make a decision on any potential investment. We talk about how that homework is done. We actively demonstrate it during our webcasts every month, known as the Roundtable. But just keep that in mind. If we do own something, we'll try to remember to mention that we do own it. But you are entirely responsible for anything that you do as a result of this. If you'd like copies of the slides, or if you have follow-up questions or suggestions, our 2 email addresses are there at the bottom of the page. Are we good?
We're excellent. Let's move to the next slide here.
All right. Yeah, we might not go as long today as we normally do, but here is kind of a look at what's going on. There are the brothers Gardner on the far right, the Motley Fool. They definitely think about it, about investing in much the same way that we do. We'll prove that here in a few minutes. Samuel L. Jackson is on the left because of the uncertainty and the confusion and the stuff that's going on in the stock market. I don't know about anybody else in the audience, but my portfolio that I'm a little more, let's call it my active portfolio, it was down, I want to say close to 6% in the morning. And I just walked around the block a couple times and came back. Next thing I know, it's up 5% in like 30 minutes. That's not normal market action. So it's probably even best to almost not even be aware that it's going on. I mean, there's a whole lot of gyrations taking place. So keep that in mind.
Tomorrow might be a good day to sleep in. Just saying.
Well, when they say don't look, probably a good idea to fight back and don't look.
Mark, we have our good friend Dean Alden with her hand in the air. So, Dean, you're unmuted. Go ahead.
Release the Dean.
Okay, maybe that's an inadvertent hand. So, Dean,
Okay.
I'm going to take your hand down and put you back on mute. If it was a good hand, raise it again later on, okay? Go on, Mark.
A couple of good articles there. These are the links that actually appear at the end of our weekly updates. I leave a while as long as we're still talking about the particular subject. Those last two I think they're classics. They talk a lot about David Gardner and early stage investing and rule breakers and all that kind of stuff. But the one I wanted to draw everybody's attention to is I think in the next week or two, we probably will attempt to have a rational discussion about tariffs and what actually happens. And I have a very high opinion of John Reckenthaler at Morningstar, and he wrote an article last week that tariffs are not the cause of what's going on. And I think I'm in his camp, at least from the get-go, that what we're seeing is actually a restoration of the trend, regression to the trend again. So I want to encourage everybody just to grab a couple articles, try to find some good ones, and we'll have a deeper discussion. I will caution you, and I'm not making this up, there are 4,291 articles at the Wall Street Journal if you just simply search on tariffs. So I'm not sure what to do with that, but there's a lot of them out there. Any thoughts here, Ken?
Nothing except does Reckenthaler's article have anything to do with tariffs might be the excuse, not the reason?
I think it might. And again, I just skimmed it real quickly, and I just put it there. A lot of times I'll just store the article here. It forces me to go back and take a closer look when I get the time.
Sounds good.
All right. And we will be talking about Barry Ritholtz's book, How Not to Invest, at some point in the future. So he summarizes the 10 biggest ideas there. So here we are. We are at the end of the first quarter for 2025. So that bar on the far right that is lightly colored will be locked in, and we will have white space between that and the long-term line of reasonable expectations. So that kind of tells you where we're at. Return forecasts are currently in a fairly normal zone or range, and anything from 9 to 11% is a fairly normal forecast right now. What do you see, sir?
Well, when they say that this quarter has been a downer, the graph just proves it, Mark. Okay, it's not been good for a lot of our portfolios, and especially for those folks that were really heavily into whatever they're calling those 7 stocks that used to be called the Magnificent Seven. So,
are they going to be renamed here anytime soon, or?
Well, they seem to be being renamed right in front of us on the different television channels. There's all kinds of new names for them. The Lagnificent Seven is one of the names I heard recently. So
completely
the reverting 7.
The reverting?
I thought of them that way in 2022. If this is the second time they've done that, actually. Up big in 20 and 2021, the cause of a lot of our band members in 2022, and then up and now back down. So we mentioned it earlier.
I'm sorry, Matt. Go on. Finish your thought.
Oh, it's just this is the second cycle in the 2020s that those stocks have taken. 2022 was the last time they were down, so they're just oscillating around a point, reverting to the mean.
I have Dean Alden's hand up in the air again, Mark, so I'm going to unmute Dean. Dean, go ahead. What's your concern?
There is no concern. I was trying to say that today is my anniversary.
Really? Well, happy anniversary.
Well, Richard decided it was the only day he wouldn't forget.
April 1st. Okay. And
anyway,
how many years?
53 years. Thank you. Bye-bye.
Well, Dean, on April 4th, that's this coming Friday, Natalie and I will celebrate our 55th wedding anniversary.
Yay, so there you go.
We got you by a year, Dean, okay?
Okay. You're welcome.
How did the weekend go in Cincinnati? Have good session this weekend? They had one.
It was excellent. We had a really nice turnout. We filled the room. We had
Excellent.
new people. We had BI members. We had meetup people.
Nice.
We had a neighborhood e-newsletter. We actually got 3 people in from that. There is some, and it was a good session. The Marty presented, and Mike Higgins and Richard did his AI presentation as best he could. He said, this is changing hourly, by the way. So
Yeah.
it is. It's just
Right.
moving so fast.
So this is just a general reminder to everybody in the audience that there are better investing events going on near you, likely, and keep your eyes open for them.
Dean, Cincinnati is one of my most favorite cities. Mark's also. So anytime you want us to come down, just say something. We can probably be down there in 4 or 5 hours. Okay.
You betcha. All right, we'll keep pressing on. Here is the Groundhog update. Once again, I cannot find my name on the chart, although I did move up 4 places, so I've begun my charge, but I'm still at 196th, so I'm sub monkey. So I will remain silent. Take it away, Ken.
Am I above the monkey mark?
Yes.
Okay, that's all I care about at the moment because my portfolio is doing terribly. Okay.
You're way behind Galogly, though. Okay, I'll be quiet now.
Well, okay. Kevin Galogly, one of our buddies, is in 19th place, but the 2 that I have to pay homage to are the 2 Wolves Investment Club members in spots 8 and 9. My grandson and Don Sheets from up in Northport, Michigan, north of Traverse City, and I will be getting correspondence from both of them. In fact, I got a phone call from my grandson about an hour and a half ago already. So here we go.
Am I above the monkey or below the monkey?
I think you are above the monkey, and you're 60th or so. Matt.
Oh,
Matt,
I'm above 100. I was surprised.
Matt, you're better than you think you are. You're in 46, so you didn't drop as far as you thought you might.
Yeah, well, no, that's fine.
46 is a good position to strike from.
I'm okay. I'm as of yesterday, I'm $150 less than BI Baker, so I'm in good company.
Are you running a marathon, Matt? Is that what you're doing?
Yeah, I was a distance runner. I'm the length of a distance runner.
It is a marathon, not a sprint, and it's early still. All right.
And the number of clubs on the list, as stated, 10. That's a pretty good number, but it's 1 smaller than last week, Mark.
Yeah, and just one editorial comment. Anytime that balanced fund, that Bogle 60-40, that's a combination of 60% stocks, 40% bonds. I mean, that is designed to not fall as much as a nasty market. And the only difference between that and the Bogle Head 3 is that it includes that external to the United States component. And that is actually narrowed. The performance contribution from the ex-United States stocks outside international stocks has actually narrowed a little bit. So they're 2 are on top of each other. Hopefully they will finish off the board. That's my hope. All right. Good stuff. By the way, if you think January was good, February was terrible, March was terrible, and we're down to those 2 terrible months are minus 11.3. So it's time for a little more sunshine, in this investor's opinion and hope. All right, good stuff. All right, so we know what to do when we see these, right? Ken, what are we supposed to do when we see that banner on the right from your friends at CNBC?
How about ignore it? Okay.
Turn off the TV.
Turn off the TV, right? Uh-huh.
Think sale.
It means there's something on sale out there, in my opinion.
I will tell you, Mark, I was very, very proud of my investment club that met last night. They listened to my presentation of Microsoft, and before I could even finish the presentation, a motion came to the floor to buy Microsoft with all the cash that we had. We had about $25,000, and we put it all into Microsoft last night. So I think that people are listening, at least in the groups that I'm involved with here. So I'm very pleased about that.
And I suspect you probably bought that at a slightly lower par than most companies. Return forecast, 12-ish?
Slightly about, well, 13 about for from our SSG.
12 or
Yeah,
13, yeah. That's just
yeah,
something, that's a topic we do need to talk about, perhaps as
yeah.
we, in the
But
next couple
that's
of weeks.
about as high a par as you're going to find on a company like Microsoft. You're not going to
Right.
find it up in the 17, 18s.
That,
So,
that's my point. And that just
yeah.
doesn't happen. You could wait forever for that. Yeah, so the point of this is you see words like nightmare and terrifying and catastrophic drops and all that kind of stuff you hear and read. To me, that's just absolutely strap on the afterburners and go shopping carefully for a good company at a good price. Excellent company at an excellent price. All right. This is a kind of a personal reminder also. This is that 401k demonstration going back to 1994. We show 2004 through 2025 on the chart. So we have dropped almost $1 million. And as frightening as that sounds, when I look at that, I look at the blue line and I'm like, this is just kind of one of the things that nudges me into it's time to go shopping, carefully shopping. And believe it or not, if we live long enough, those big drops will actually look like 2008 on this chart at some point in the future. So that's my belief. Could be wrong, but I do believe in regression or reversion to that trend, that blue line, and that's my story. I'm kind of sticking to it. Ken, your thoughts?
Well, if I could look or talk to anybody that's in the audience and have them say, my retirement account is only worth $4 million, I think they'd be fairly happy about that.
Yeah, it's still, we're not pretending it feels good, but got to keep it in context. We did drop over $1 million during 2022, as Matt pointed out a minute or so ago.
Yeah, that's been my point of view. I have a few newer investors, but very good investors that I mentor, and when they're down, that's the first thing I say. Where were you the summer of 2022, and where are you now? And consider that your progress, trough to trough.
Yep. Good stuff. All right. This one comes to us courtesy of Len Douglas because he wants to brag a little bit, and I don't blame him. This is a list of companies that have done very well since the turn of the century. Keep in mind that this was right after Y2K is the starting point. So we're going back 25 years. And this was basically the peak before the wheels came off shortly thereafter. So you're talking about going back quite a ways to those days. But 25 years ago, over the last 25 years, these are companies known as 100 baggers here. It's a pretty interesting list. And I'm proud to say that I have a few of those, not quite for all of those 25 years, but quite a few. And of course, Len is pointing out that Texas Pacific Land kept up with NVIDIA, if you're keeping score. And he publishes a lot on Texas Pacific Land.
I just have a good comment, Mark, okay? You know you're old when you hear the phrase turn of the century and your mind immediately thinks 1900.
Yep. Well, there's some awfully good companies on here. Now, Monster had quite a runaway there for many, many years. Kevin Gologly talked about that one in a presentation a few months ago, but there are some definitely community favorites, almost household names on this list, and many of these have been good to us. Middleby is a company that the Motley Fool brought to our attention back about 25 years ago. And of course, Apple has been significantly in the radar screen over the time. There are stories we could tell about most of these, but what's your favorite? What are among your favorites on here, Ken?
Well, back when Mark first began Manifest Investing, he was asking me to write an article for him every week or two about a stock that I found interesting. And I got enamored of the trucking industry. And my very first article was about Knight Transportation, which is now Knight Swift. And I followed that up with an article on Old Dominion. And I grew very enamored of Old Dominion and bought some. So Manifest was founded in what year, Mark?
2004. And
Okay, so I have Old
2005.
Dominion dating back to 2004. Then I've held on to it ever since I bought it. It's had some flat spots. It is economically sensitive when you have something happen like in 2008, for example. But for the most part, it's been a good, solid growth stock, and this chart just kind of bears that out. What's it, number 5 on a list that includes NVIDIA and Monster Beverage, so I'm pretty happy with that.
Yeah, and quite a few people in the community have been big on Deckers from time to time, and that had quite a run. Tractor Supply of, basically Home Depot Junior, if you want to think of it that way. They wouldn't like that I said that, but a number of people within the better investing community have been following and fans of Tractor Supply for quite some time. So that's a good list. ANFS is a good one too.
Tractor Supply was characterized to me when I made my first and only call to investor relations for Tractor Supply that their audience was gentlemen farmers. So that's the term you're supposed to use, I guess, if you're speaking in behalf of the company, Mark. Okay.
All right. Well, I was with some Superman farmers this weekend, so the high-powered ones with those huge machines and stuff. Good stuff. All right, so here's a look at, I just took the top 3 plus NVIDIA, and NVIDIA was already on this list, but just wanted to give context in terms of these numbers are huge. These are, the percent changes in 100,000, 70,000, 60,000. On an annualized basis, here's how that scorecard looks. And it's quite telling. It's a reminder that you can find companies like Deckers and do extremely well with it. And that's down significantly from just a few months ago. And just good, clean, fun. Texas Pacific Land has been good to its shareholders over the years. And a lot of good stuff. When I see this type of a chart, I'm reminded of the time when I came down for breakfast at a better investing event, and the investor relations person from, now the name's going to escape me, Biomet, was talking to my parents, and it was around that 2000 time frame, and they basically said, well, $2,000 invested back in that time frame, 20 years later was worth almost $1 million. You don't need the next Microsoft, you need the next Biomet. And the next Microsoft would be good, but sometimes it's as simple as finding a good Biomet or Old Dominion. Well, Ken, the Buttonwood did drop off a tiny bit. Nothing to.
For a 14-month-old portfolio, Mark, with 2 bad months in it, I still am not willing to throw in the towel or anything of the sort. It's coming close to matching the market at the present time. I just think we have to be aware of what's happening. And when you're building a brand new portfolio from nothing, I think you have to be willing to do a little bit more tinkering around with it than you would be in a nice portfolio that you've had sitting in your brokerage account for the last 10 or 15 years. You might be doing more selling and more buying than you normally would be doing if this were a stable portfololio that you had reached a point that you're very, very pleased. We're pleased, but not very pleased with it yet.
Not yet. Not enough runtime yet. The number I want everybody to fixate on as we go forward is, Ken was a little bit rough on us during the last roundtable, so I want to work towards some context here. That's a 4% beat of the stock market. The roundtable's checking in at about 15.5 now. It's down about 1% in the last couple months, but that's versus an 11% stock market. So keep that 4% number in mind as we think about the performance of that roundtable, our monthly webcast. All right. All right, a quick commercial from the Motley Fool Stock Advisor. I got this email this morning, and it sounds good. I mean, they have an investment that can turn 5,000 into 500,000 soon. And it has to do with this program, the White Lotus, which I don't know a whole lot about, but some of you out there do. And they're going to be a new luxury and real estate empire, and you can get in to their pre-IPO for as little as 1,000 or as much as 10 million. But they won't allow you to invest more than 10 million, apparently. And then you can see on the right there, there's some really fantastic things that are involved here. And Ken, I think I missed this one. I could have had 129 free shares.
Well, no, I read that because I got the same email, Mark. Okay,
You actually did that?
I think the next page, however, really seals the deal for me. Okay, because the next page says if I'm really fast in my investment, I'm going to get more stuff.
And
so
they're also sponsoring one of these. It's a 4 times leveraged fund. And it's like I sent a note to Tom and Dave. I said, what could possibly go wrong when the market down 25%? Didn't get an answer yet to that question, but we'll see. And wait, there's more. This is the steak knife page. This was Ken's favorite.
I love the fact that if you're one of the first 4,000 investors, you're going to get a 25% discount on the share price. So I'm ready to put my money in. I'm very disappointed that I can't put in more than 10 million, Mark, but I'll have to live with that. Okay.
Well, I did buy 10,000 shares on their page. I used e-meringue currency from a few years ago as my source of funds, so I can't wait to hear from them. But notice that they are guaranteeing. This is so awesome. They're usually so conservative too. They're guaranteeing a 15% return.
I'm going to get a 15% discount, Mark, because I'm going to forward this email that I got to everybody on the Mid-Michigan guest list, okay? So maybe they'll give me even more than 15% if I tell them that we forwarded to about 2,500 people, okay? What do you think?
That's just for one forward, or can we double down and get 30% off? Or
that's what I'm going to ask. I'm going to ask because it's not as clear to me as it should be. So
I've got a couple of feelers out there to see what's going on and what we might do, and I guess we'll come back and explore that dramatic opportunity in the future. Well, here's your non-April Fool's reminder that Tom Gardner, he's the brother on the right, was our groundhog champion for this past challenge. And his 5 stocks that he picked are right there. He turned $1 million groundhog dollars into 1,472,000. So he was the best performing celebrity or institutional participant. And we celebrate that. And I'm told that is a very White Lotus-like scene with the rhino and the groundhog on the right. I have to go off third-party opinion, but you can see the previous winners of that award. And this is what Ken was talking about a few minutes ago. These are the top 20 out of about 650 funds that we follow, mutual funds and exchange traded funds, and they are ranked by their performance. Now remember 4%, 4.1%, that would place the round table right here. And that's not bad. That's out of 650 funds. Institutional funds, so that the round table performance is just fine. The other thing that we notice here, again, these are the top performing funds over the last 10 years, trailing 10 years, and look at the growth rates of the portfolios. And again, this goes back to the question from Phil in the green room. This is one of the reasons that we like to see 12, 13, 14-ish for the growth rate of our overall portfolio. And we keep reminding Full 100, which we're going to look at here, is in the top 11.
I think, Mark, that to further build on that, that's why I think when you're looking at Buttonwood or some of the portfolios that we might demonstrate with some of the model clubs that I'm involved with or that we do reviews on, I think that's why you might see us skew a little bit towards a larger number of faster growing stocks and a larger number of these mid-sized growing stocks. And both of those numbers would be at the expense of a smaller percentage of really more slowly growing stocks in that 7% or less range. because we do feel that you have to push this up to 12.5 or 13 to achieve that +5 on the market. And I think there's a reason for it. When Nicholson put together these concepts of 25, 50, 25 for faster growing, the workhorses and slower growing companies, he was looking at an average dividend yield in the 3.5% range. And we're just not seeing dividend yields like that anymore. I think in today's market, you would be excited by a 2% dividend. And if the dividend's not there to contribute to the portfolio, then you have to get that contribution in another way. And we think these funds are getting it through buying faster growing companies.
Absolutely.
So that's our premise. That one outlier, number 7 on the list, just note the date. The performance since date in the third column over. This is a brand new fund, and I'm relatively convinced that as that number and the date comes closer to 10 or 12 years, that growth rate is going to have to change for it to maintain its relative return of +5 on the market.
And I would predict that it will. I have followed the team fairly closely, and they think like we do. I think that as you know, it's really new, so it's a small sample so far, and they are moving up this list in a
Yep.
nice
No
way.
doubt
So
about it.
I do watch. I will continue to watch on a quarterly, well, actually more than that, monthly basis. What are they buying as a potential stock to study.
And when you see, Mark, that the 20th best out of what did you say, 600 some odd funds, 650 funds?
Yes.
The 20th best is only, and I'll put that in italics and put quotes around it and underlined it, it's only outperforming the market by 3.5 percentage points, 3.4 to be exact, which means that if that's where your investment club is, +2.5, 3.5 to the market, you shouldn't be beating yourself up about it. 20th place out of 650 professionally managed funds is no slouch. And if that's where you can place your club, I think you're in very good company, and you're doing very, very well compared to what the average investor might be attempting or putting together in their portfolio.
All right, so that's why I had this here for context and that reason to reinforce what Phil's question. Those of you wondering about the highlighted fields, those are fields I had to calculate manually because of a glitch in the Y-charts data, and I'm mad at them. So, those are manual entries that I had to do by hand, and I just don't like to work that hard. So that's why they're highlighted, and I'm continued to send that over to them and say, hey, it's still not working. All right, here's a look at the Motley Fool one. They will fix it. Here's a look at the Motley Fool 100 Index Exchange Traded Fund, TMFC. So TMF, the Motley Fool, C for 100 in Roman numerals. So TMF Charlie. And this is the top 25 holdings of the fund. You see that it actually does account for nearly 80% of total assets. And how do you react, Ken?
Well, Mark, you and I have looked at hundreds of better investing portfolios, and one thing that we agree on every time we look at a better investing portfolio, we notice that they don't have any problem picking high quality companies. And neither does this Motley Fool 100 index, with a quality rating, an aggregate quality rating, a weighted average quality rating of these 20 stocks here of 92. They understand quality the same way that we understand and we define quality. So I don't have any problems with this portfolio. I think a good test for whether or not any list is something you should pay attention to is you need to take a quick look at the list. And if you don't own 2 or 3 stocks on the list, then it's probably not a list you want to spend a lot of time exploring. Here's a list of 20, and I would imagine that most of you, if you're looking at this list, own more than 3 or 4 stocks on this particular list.
I'm going to do
full of very familiar companies.
I'm going to do the ones that I own just for kicks. Yeah, this one I sold and forgot to replace, so shame on me. That is about it. Although Ken has almost got me talked into this one down here. So yeah,
Yeah.
pretty good list. Good stuff. Yeah, look at the growth rate. The growth rate is solid. The returns are upper single digits. So good stuff. It's a good fund.
It is skewed a little bit towards a little bit more slowly growing companies that we would prefer in one of the top performing funds. The growth, the weighted growth for this sample is only 11.5%. That's darn good. But again, I think that we would prefer to see that at 12.5 or 13, and that would then help us maybe push the par values up a little bit.
I do own a few shares of Tesla. All right. Here's a look at the performance over time. Yeah, this is just simple proof that stock prices do indeed fluctuate. You can see the pain of the last 2 months on this. This is a monthly chart going back to 2018, the birth of this particular fund. And yeah, fluctuates, but the trend is in the right direction. Here's another compilation just looking at some different sources of potential ideas to study. The Motley Full Stock Advisor it's one that I do and have subscribed to since it first came out. So I'm a charter subscriber of that fund, and it has been an excellent source of ideas. Although if you throw 3 ideas from that particular newsletter at me, I'll pick the worst one 9 times out of 10, even when it's a good one. But that's just a curse that I have. I know nobody else suffers from that.
I can attest to that rule, Mark. It works for you. Okay.
It does. You can see it in some of our picks. But Everlasting is Tom Gardner. Rule Breakers is David Gardner. And these are just the 2023. We've done extensive analysis of the Rule Breakers. You can go back and look at that. This is just 1 year, but just again, stacking them up against other sources of ideas. And we did just start tracking these guys here recently, so we're going to be watching them closely.
Yeah, that excess return column is the same as relative return, just different vocabulary. And they're using a different benchmark than we use. They're using the S&P 500 as their benchmark, and we're using the Wilshire 5000. But over long periods of time, most of the indexes kind of track together.
Yep. So just an FYI. And then here, of course, is my belligerent tweet at David and Tom this morning. Just trying to get some value out of those E-Meringue shares that I bought many years ago on April Fool's Day. So we'll see what happens. I'll be back with their response if I get one, as long as it's something that can be shared in public. All right, so let's go ahead and spend the last 15 minutes or so talking about this particular topic. This one comes to us from Ty Hughes. You guys have heard Ty do a number of things like this here lately. And what he has done here is he sent me an email where he basically took and asked this question of the X or Twitter AI that is known as Grok. So we've been talking a lot about, do we need some form of this when it comes to AI? And we will be talking about that more and more. But Ty, would you like to summarize, what you were thinking? And I like the way you've worded this.
Sure. Well, the thought here is to these different AI engines aggregate a lot of different information. So to get a good answer out of them, you have to sometimes set up the question, and that's what I try to do here. So, we're long-term investors. I pointed out that we look at quality growth stocks and that we're looking out 12 to 24 months. And so that was sort of the predicate on in fact, almost anything you do with AI, it's helpful to put the context in before you ask the question. And then I loaded in the portfolio that we have for Buttonwood. I did go back and ask how did they come up with their projections, and got a pretty long answer. They start out with free cash flow, then they look at the projections that are out there. I guess this is part of the aggregating the information. Then they also look at PEs and try to make some judgment of whether a company is over undervalued, and they look at industry trends, and somehow, and I don't know how exactly, somehow this model then puts that all together. And in the answer to how did you do it, it said, well, we provide a directional analysis taking all those factors into account. So quantitatively, I don't know exactly how it does it, but it's interesting because those are some of the same things that we worry about, aren't they,
Right.
Mark? You know, the same kinds of issues.
Absolutely. And now, Ken, you actually were you able to confirm that you could go to X or Twitter.com and access a free version of this? Is your version free?
I did not go through Twitter itself, through X itself.
Yeah, Grok.com. Yeah, Grok.com.
I just went to Grok.com, and I was able to get a subscription that was kind of a trial subscription, and I can play with it. And I think I have, I don't know, 30 or 60 days, something like that, to decide if I'm going to put a little bit of cash behind it. But I was able to play with it a little bit, and it was free for the moment. I'm going to do an advertisement next Thursday, not this coming Thursday, not the 3rd, but next Thursday. Susie Artsberger is going to put together a 35-40-minute section in a Ticker Talk where she's going to talk about a number of these AI engines and try to give you a little bit of guidance on how you can subscribe to them and which ones, if any, are completely free and which ones will take small subscription rates. If you're looking for that kind of information, she's going to be providing some of that at the Ticker Talk, and it's going to be again on the 10th of April at 8 o'clock in the evening Eastern time.
Sounds like it'd be well worth it. So here's a little bit more of what was spit back at Ty. Again, I'm not going to spend a lot of time on this page. You can read this at your leisure, but a quick description of the companies that we know fairly well. Here's the meat. Here's the ranking of the portfolio. So what was your reaction to this, Ty?
Well, it's again interesting. I have a number of these companies in our investment club, and I also follow a number of these companies. So I thought it was an 80% concurrence on my part, or 80% right. I don't know that I disagree. Gentex is interesting where that falls out. That comes out in different places, but in terms of the likely gain for those companies over 12 to 24 months, it's a reasonable judgment there. I do think it's interesting to ask it too, what if any stocks in a portfolio should be sold, and then the follow-up question you can ask is when should they be sold, and the answers are very interesting. It will link a stock that it thinks is going to underperform the portfolio, and then says, but there's an earnings report coming up, or there may be a change in the industry trend, so you may not want to make the decision on that stock until after the next earnings report, or until after 2 months from now. It will actually provide a time-phased when to sell recommend, and they're very careful that they say these are not financial recommendations, but you can ask it that question and it'll give you an answer.
Ty, one thing that I'm going to be kind of excited to do in the next 3 or 4 days is I've been looking for a good example of when news makes a major change. How will that affect the potential that the AI engine assigns to the stock? And I think United Rentals has provided us with a perfect example. I happen to own that in one of the clubs that I'm in. And one of the reasons that it was purchased in the last 2 or 3 months was the upcoming potential, almost sealed deal for them to purchase a very large competitor and add it to its stable of companies. And just today, or maybe last night, it was announced that they were going to abandon the deal because the company they were going to acquire demanded more money, and United Rentals decided that it wasn't worth buying it. So there's going to be a sudden change in the future potential for this company, and I want to see how an AI engine handles that.
Mm-hmm.
So I think that'll be something that I can put into this and see, does URI stay in the, up around 5, 6, 7, or does it drop down this list now to 10, 11, 12, or even lower? I don't know, and that'll be something I want to do.
Yeah, and one of the things that I find almost chilling is this is our challenge pile. You and I had that discussion as to what companies do we want under the microscope, and they've matched that. So that I feel a little bit wiretapped on this one. I think somebody's listening in on our conversations or something, because it's a bit eerie, but it's kind of cool also. I want to see this. I want to see some repeat performances of something like this for sure. Good stuff. Well, here is the Buttonwood portfolio. We will make adjustments to that next week. It's holding in there pretty well from top to bottom, even in the tough month or 2 months here. And this is what Ken was talking about. Here's a look at United Rentals with some of the analysts backing down after the proposed merger looked like it wasn't going to happen. This is from the current Value Line update in the Value Line Investment Survey. And those numbers are a little bit different. Notice that you see 10 or 11 here versus what you see here. So that's what happens. This thing has basically fallen apart from the last time. It's moderated. The growth expectations have moderated a bit. I think they were probably a little bit frothy before, but this is what Ken wants to see the robots pick up on and basically warn about. All right. I think that's it for this week, Ken. Here is our reminder that we do archive these sessions on YouTube, bull sessions and roundtables, and our educational sessions. You will find them there. So if you go to YouTube, just search for Manifest Investing, bull sessions, and or roundtable. And if you have any trouble with that, reach out to either one of the two of us, and we'd be glad to help you. Upcoming events, we are going to be a couple weekends from now. It's actually a couple Saturdays out. We're going to be at the Rochester Hills Public Library. That's right here in the center of the Detroit suburbs to the north, and kind of in my neighborhood, but we're going to have a Southeast Michigan program. Ken and I will be there to deliver, basically what's on your mind. Let's talk stocks. Let's have a little bit of breakfast club and have some fun. And so if you're in the area within driving distance, I'll buy you a bagel that morning, or maybe Ken will.
Price is right, Mark. Okay.
Actually, I think I will pick up some donuts at the legendary donut shop right on the corner. Bring them in.
Mark, can I also say that on April 5th, this coming Saturday, Mid-Michigan chapter is sponsoring a help session for novice investors. We're going to have Mark and myself and two of our directors there to answer questions about the SSG Core and the SSG Plus and anything else you might have. It's aimed especially at novice investors or folks that are brand new to the better investing tools, and we'd love to have you show up. It's at 11 o'clock in the morning, Saturday morning, and we promise to spend at least an hour, and we promise not to leave until we get all the questions answered within reason. And if you can't find a place to link to sign up for it, send me an email directly, kkavula1@comcast.net, and I'll send you a link out with the email that's going out today to remind all of our members on our guest list and our own chapter about the event. Again, that's this coming Saturday, 11 a.m.
We do have it on the event listing at Manifest too, so you can catch it there also, as well as the Mid-Michigan chapter. And this is the reference to Stay Hungry, Stay Foolish. It's from a commencement speech at Stanford. It's one of the more famous commencement speeches of all time by Steve Jobs. And he closed with a commentary on, was it the Whole Earth Catalog? Does that sound right?
Yeah, that's exactly right, Mark.
Okay. The Whole Earth catalog, and this was their last catalog, the last page of their last catalog. The encouragement to always be out there, and this is done in the spirit of continuous and persistent learning. I think it's kind of a cool thing to honor. The Motley Fool, in my opinion, has done this for over 3 decades. So they have stayed foolish. Anything else, sir?
No, Mark, we're under an hour, so let's close it down and break our record, okay?
Okay. We have a couple under an hour.
All right.
All right, I'm going to shut down the recording. Thanks, everybody. Let us know if you want to hear about anything or if you have any follow-up needs, questions, comments, or suggestions. Thanks,
Good
everybody.
afternoon, folks. Glad you were with us.